Hey guys, it's Drew Ebner here at Guild Mortgage. Excited to be a contributor at the mortgage reports this month. In this video, we're talking about the nitty-gritty details of how to qualify for a VA loan. And hey, if you're interested in the real estate market in general, click the subscribe button. Tons of great content on this site. And hey, if you like the video, give me a thumbs up too. Buying a house zero down, is it possible? Absolutely. Most of our clients come to us with a little bit of the fear that I'm going to tell them, no, you cannot buy a house. That they've heard from their parents or grandparents that they have to have 20% down or a large down payment. And it's simply not the truth in this case. But a lot of the misconceptions is, again, if I don't have 20% down, I'm going to pay mortgage insurance. Might not necessarily be the case. And the perfect example of that is a VA loan. So a VA loan is for veterans, obviously, that have been honorably discharged and have the ability to go put zero down with no mortgage insurance. That's a key factor, guys, because if you're in a metropolitan area like we are here in Seattle, mortgage insurance can be $400-500 per month on a house that is $600,000 on up. So $400 to $500 a month is going into your monthly budget just for mortgage insurance. It's going to affect your ability to purchase in that next marketplace. Just think about this. So if you're very conservative, the cost per ownership is about $60 per $10,000. And if I'm eating up $500 per month in mortgage insurance, you're getting crushed in your ability to purchase in that next level. Hey, if you're in a metropolitan area, buying at $400,000 versus $500,000, game changer. So again, with VA, zero down, you're gonna have a little bit more favorable underwriting criteria. And what it means by that is credit scores can be typically in that 620 range. Case by case basis, most lenders in general will allow for a little bit lower, but you're gonna have tighter guidelines on underwriting. Also, as far as debt to income ratio, they'll a little bit more lenient there too. Typically you can see close to that 50% debt to income ratio, but with VA, there are a few caveats that you gotta be aware of. One thing to be aware of about a VA loan is that you're gonna pay a VA funding fee. First time users, it's gonna be around the 2% mark. For repeat users, you're gonna pay a little bit more than 3% in most cases. So that's automatically rolled into your loan amount. So if you're going zero down and that's your only barrier of entry and you have that VA funding fee, then so be it. I mean, you're getting into a house, you're getting appreciation, you're getting a tax deduction, and it's a cost of ownership. If you're a second time user for VA, that jumps. It jumps to over 3%. That's automatically rolled into your loan amount. So some things just to be aware of and some things to factor in. Also, if you do have children, there's kind of a gotcha with VA. So what to be aware of is that the childcare expense, it's actually a form that we fill out, and that's actually deducted from your income. So it actually makes it a little bit tougher to qualify. So in a metropolitan area, I'm using that as an example, the cost of childcare can be thousands of dollars per month. And so you do have to fill that form out and it can affect your bottom line. So it's something to be aware of. It's certainly come up in the past with our clients that in the upfront stages, it looks great. And then once we actually do all the paperwork on qualifying, that they qualify for less because of that. So we're getting technical here on VA. So another thing to think about is there's a residual income factor as well. So it's not your regular income as a Fannie Mae or Freddie Mac loan is not calculated the same way as VA. So there's residual income and it's based a little bit differently. So it's just something to be aware of going into it, that your income is looked differently. One things with veterans, if you are at all recognized by the VA as having some type of disability, 10% or greater, that VA funding fee is automatically waived. That's huge. So if you can save 2 to 3% being wiped out and not being financed into your loan, huge factor. So it's always something, so whoever you're working with, a bank or a local loan officer, always mention the factor or the fact that you do have a recognized disability from VA. The next thing is working with your real estate professional. So I've been in the lending industry for about 20 years now, and I can tell you there is a stigma with real estate agents about working with VA and the appraisal process. Typically, I'm not joking here, I get a moan on the other end when I call to introduce myself to sell the client's ability to purchase, and that we are using a VA loan. Don't worry, it's pre-underwritten, and we're all good. But the number one question I always get is, Drew, am I going to have a tough time on the appraisal? Are they going to beat me up on the appraisal? Because then they share some secret about the house that they don't want the VA to know about, or the seller to know about, or the buyer to know about. Hey, there's some rotten deck boards. Is it going to be called out? We have a rotten fascia board. Is it going to be called out? There's paint chips on the south side of the house because it gets beat up by the sun. So if there is some deferred maintenance, I can tell you, VA, it's going to get called out. Just beware, it's going to get called out. And it may have to be repaired. So if you're going into a fixer-upper, there actually is a VA renovation loan. So you can actually pivot. Not all companies offer it. We do it. We broker it through a company called AFR. They're really good at it. But the VA renovation product is its own separate beast. And so if you're going that direction, you want to be fully prepared. It's a different animal. But you can finance the improvements into the home, worst case scenario, if the seller is unwilling to fix it up. So I wanted to share an actual success story that we had, a loan closing in 2019. So our client, Tom, had been beat up in the marketplace because the fact that he was a veteran and he was going zero down, and the product he was looking for, very specific in Seattle metro area, was a duplex. So duplex is very competitive as far as people being interested in them, and especially if it can cash flow. You're going to have people that are putting 20 to 25% down. So we really have to have a solid loan package, sell it to the listing agent to make you look very successful. And you are, because you're underwritten. That's always the case that we do. But in this factor, we were able to negotiate repairs. We were able to negotiate many other things about Tom's status with the VA because of that appraisal. So sometimes people you view it as a negative, but because the VA appraiser did call out a few things, we were able to renegotiate wiring, which actually was to the tune of $9,000, and that led to another item, plumbing item, that we found out about, which was another $1,500 fix, all because of the VA appraiser actually being smart enough to check a few of the electrical components in the house, what led to saving our client over $10,000 of items that he was not picked up in the initial inspection. In qualifying, because he was buying a duplex, we're able to use that future rent to credit to offset his debt to income ratio and buy in a little bit upper, more affluent area, because he's going to owner occupy one side and rent out the other. So it's kind of thinking outside the box with any loan program and any situation, and the VA loan gives you that opportunity to do so, to get home ownership, to be creative, and to have flexible underwriting criteria and take advantage of whatever your local market is. So it's the part of the dreaded part of a VA loan is, how do I actually qualify, Drew? What paperwork do I need? Well, sometimes you need a lot, but since we're in the age of computers, most of the time with just a social security number and a borrower's authorization, I can actually type your information directly into the VA and find out what your benefits are. It's that simple. If you served prior to the Gulf War, sometimes we need to do a little bit more digging around. So copies of your DD-214 are always recommended if you have it on hand. Also, if you're recognized as having some type of disability by the VA, 10% or greater, again, we get a VA, waive that VA funding fee. So have that ready, and definitely, if your lender doesn't ask if you're recognized to have a disability, please tell them. That'll save you, in some cases, tens of thousands of dollars. Pay stubs, W-2s for the last 2 years, tax returns for the last 2 years. Be aware, if you do have childcare expenses, have that ready to go, and so we can document it. Those are the simple things that we're going to need to get you in. We're always going to have to, if you're coming in with down payment, we're going to verify that as well. So 2 months of bank statements. If you do have reserves, such as a 401k, that's great. It just even makes your case with an underwriter that much more solid. So guys, I hope this helps. Learning about a VA loan and all the good things about it. Again, it's a great product. It's 0 down, no mortgage insurance. You can't beat it. Very, very attractive rates in this marketplace. So hey, if you have any questions about a VA loan, how to qualify, the Ebner team at Guild Mortgage are always here to serve and help. We'd love to be a resource for you. Thank you for watching this video.